Good evening. This is Dwayne Lowry for the DPP Grain Desk. It is Sunday, November 10th. First of all, the outlook for tonight or this week in general is still going to be based largely on reactions to Friday's USDA reports. So let's start with a summary there. The data from USDA was not bullish, but everybody knew it was not going to be bullish. Market reaction was supportive. That's not a surprise given the how oversold the market was and how excessively bearish trade sentiment was, and the data turned out not to be as bearish as feared. We talked about this before the report, that there's a good chance that regardless of what the report came out with, the reaction was going to be some sort of corrective activity. The data, if you look at from a carryout expectation level, beans pretty much in line with estimates, and everybody knows that that carryout number is going to shrink in the months ahead due to demand that seems to be ever building. The corn carryout was less than worst feared, not significantly less than official trader estimates, but quite a bit less than what people feared. From a supply standpoint, I think Friday's reports marks the end of the supply discussion in terms of having any significant impact on day-to-day price activity. Markets have been weak. We know that. We got a corrective strength on Friday. But trader attitudes are going to remain bearish, and I understand why that is the case. You've got about a 1.9 billion carryout estimated for corn. I think in the end analysis, it will be something less than that due to stronger offtake domestically, and I think there will still be better exports, even though USDA revised it up in yesterday's report. So I think the carryout projections from here forward will shrink in both corn and beans. That in and of itself is not bullish, and it may not be something that warrants a lasting or multiple month type of bullish trend. But I think it is very fair to say that with last week's lows, with the culmination of the supply side storyline finished with Friday's reports, I think that we can stop talking about bearish supplies. I think we can stop talking about excessive carryouts in terms of having an impact on day-to-day prices. You got to realize that just because there's going to be an abundant supply, that's not going to dictate price trends every single day or through every 5-6 week window. There are other factors that come into play. The market has digested all of this. I think the initial rally here in corn, not so much maybe in beans, but the initial rally here in corn will fall prey to willing sellers on strength not too far above Friday's highs. We can easily revisit last week's lows. We might even jab them out, but we're not going anywhere. We're not going to materially go anywhere on the downside at this point in time. We're going to be well supported. The harvest pressures will end. The bushels that are put in the bin are not going to come out next week or 3 weeks from now, and they're not going to come out with a small 5, 10, 15, 20 cent rally in corn. When you look ahead, maybe the U.S. producer will be encouraged to become more aggressive with sales sometime in the spring, early summer, around if planting season goes well, things of this nature. But between now and then, the producer does not have any cash flow needs, cash flow concerns. Producers are well heeled and have had several good years. They're not going to be pressured into making sales because of cash needs. So I think the producer holds tightly. Cash basis tone will be firm. That'll be true with corn and beans both. And I think between now and mid-February, maybe even mid-March, markets are going to be supported at recent lows, and you're probably going to get some corrective rallies. I still think it's very plausible to be able to target $5 July futures as a legitimate hedging opportunity, and that's where you're going to want to make sales. You know, you're talking about a 50-cent rally from where we're at right now. That's not unreasonable, even with $1.8 billion carry out in corn. But because the reason it's not unreasonable is because we've already digested worst case scenarios into the marketplace, and if we are going to get to significantly lower values, it's going to occur sometime later. It's not going to occur now. So I think that a producer has to be patient, wait for better selling opportunities, have orders in above the market at levels that you're comfortable with. But I think you're patient, expecting the opportunity for that to occur. Excuse me, I've got a cold here. As far as soybeans are concerned, the carryout is somewhat adequate, but the reality is that carryout is going to get smaller. The soybean futures market has room to go higher. It has opportunities to trade weather concerns in South America. At the present time, you know, all things are well, so to speak, down there. But I think the opportunity and just the sheer odds favor some sort of increased uncertainty at some point in time. But demand in and of itself is going to keep the soybean market well supported. And Friday's gains in beans, you know, some may look at that as overdone. But if you back off the market 20-25 cents from Friday's levels, you're going to have buying from the fundamental sectors and the technical sectors of the trade. So I think that market will be well supported. The reports are now behind us. The supplies or numbers are largely known. The key takeaway points here after Friday are that the bearish data involved with Friday's reports are not as bearish as it could have been